Dollar cost averaging is a bad strategy. It's basically how you approach the market. Hey, it's Coffee with Rob. Let's have a wee coffee. Always good. Coffee with Rob, why not? Now what the DCA guys will tell you is that all the pros don't have stop loss. Hey, for those of you who don't know me, welcome, I'm Rob. And for those of you who do know me, will know that I don't play into DCA. And you'll also know that I call the markets a 50-50 game. If you're dollar cost averaging, it'll probably end in tears. And I've seen it over the last 30 years of trading. I've seen so many people try the dollar cost averaging route, and it never works. So what I'm going to do today, I'm going to compare your DCA system to our risk management system, because many DCA traders tell you that risk management doesn't work, that you're throwing your money away, that you're not going to make money when you have a stop loss in the markets. Many of them will try and promote to you that the pros don't use stop loss. And they're not lying to you. They're actually telling you the truth. The pros don't use stop loss. The big companies don't use stop loss, because how can you use stop loss when you're buying hundreds of millions of dollars worth of shares? You're looking for liquidity in the market, and it's not possible for you to use a stop loss because you can't stop out $100 million trade. But by the same token, they're also not day trading. They're not trading 5-minute time frames or 1-minute time frames, because where are you going to find stock to buy, $100 million of stock to buy? 5-minute time frame trade. It's going to take a lot of time to fill that kind of liquidity on anything that you buy, whether it be an index, Forex, commodity, whether it be a share. This is not something you do in 5 minutes. So their idea of trading is completely different to yours. You and me are Mickey Mouse retail traders that are trading off their scraps. We're trading in the middle. In other words, we get geared trading for number one, and we put our cash in, and we get a 10 to 1, 101, 51, 50 to 1 geared trading, funded trading system, and we take a trade based on their liquidity, based on the movement in the markets, based on the traders in the markets. You're not trading squiggly lines. You're trading against traders. A market is made for trading. So there's a whole bunch of traders that are buying, and there's a whole bunch of traders that are selling, and they all believe they got a system that's going to make them $1 million. And at the end of the day, all you're looking for is that liquidity in the market, which is mostly provided by the pros in the first place. So I say to you, yes, the pros don't use stop loss. So today I'm having a heart-to-heart talk to you about DCA, about risk management, and we're not going to go to the charts and do the charting thing today. Today we're just going to talk. Today we're just going to chat about whether dollar cost averaging works, because I actually tested it again recently. And for my subscribers and the guys that come to my live show, I did say to you guys that you're welcome to, we can sit and we can do a little DCA challenge, and we can try it out for a couple of sessions and see what happens. But I guarantee you, once again, like always, it's going to fail. And here's the maths behind it. The maths doesn't compute for a dollar cost averaging system. The maths doesn't work. Somebody tried to say to me that they're changing their leverage with a crypto. That, guys, 9 times out of 10, you can't change your leverage. Your leverage is your leverage. And at the end of the day, what you're changing is your dollar size. What you're changing is your trade size, not your leverage. So all I'm saying to you is this. Here's the maths, okay? When we do a risk management system like our system, our risk management system is pretty straightforward. It's basically how you approach the market. Hey, it's Coffee with Rob. Let's have a wee coffee. Always good. Coffee with Rob, why not? Guys, when you do a risk management system, it's about how we approach the market. So the way that we approach the market with any system, it doesn't matter what system you use. If you're using support and resistance, if you're using just the standard price action support and resistance, if you're using MACD, if you're using a moving average crossover system, if you're using Fibonacci, if you're using the Ichimoku, or whatever you're using, doesn't matter. Whatever happens, it's a 50-50 game when you take the trade. You can take the trade with absolutely no system whatsoever. And if you approach the trade correctly with the correct risk management system, you'll actually have some success. Now, the way we approach our trading is a 2-step business plan system. You don't have to write it down. It's not rocket science. What I do, what we do, our community, is we risk 1% on every trade. If you want to risk 2%, that's fine, but we risk 1% on every trade. So if you have a $100,000 account, you're going to risk $1,000 on every single trade with the knowledge that we might win 5 out of 10 and we might lose 5 out of 10. But what we're trying to do is lose less on our losses and make more on our wins. So what we're doing is we're risking now $1,000 per trade with a view to trying to make $2,000 or more on every single trade. How do you do that? Because the psychology is, as soon as you're going to a win, you want to get out, you want to click sell, and you want to take the money. The trick is this: when the trade goes into a loss, because it always does when you take the trade for the first time for some other unknown reason, it always goes into a loss. I remember one guy once telling me, Rob, when you want to take a trade, where are you going to put your stop loss? Now I'm going to put it there. Wait, and take your trade from your stop loss. You'd be surprised how many times that works. So I don't know if you've noticed how often you take a trade and it goes into the red before it goes into the green. This is very, very normal. So if your trade goes into the red and it goes down to your stop loss and it takes out your $1,000 stop loss, do not move the stop loss. Do not dollar cost average. Accept the loss. Walk away. That's one loss. New trade. Don't try and revenge trade it. Don't try and put money back into that trade. Just look for a new trade. Even if it is in the same trade, look for a new trade. A trade that'll say to you, this is a trade that might work. That's what you're looking for. But if it goes into profit, now your trade goes into profit and it's $50, $100, $200, $300 in profit. You got $1,000 risk, remember? Now don't go and click sell and take the $300 profit. Don't run away. Don't back out, because this is what most traders do. You know, the psychology is much harder when you're winning than when you're actually losing. So what most traders will do with this system is they'll get out too early. What you got to do is hold station. Sit on your hands, as they say. Don't do anything. Let it go more into profit. Let it go $500, $600, $700 into profit. Look at the charts. Take a step back. Look at the charts. It will go there because the charts always go there. That's why you've taken the trade in the first place. The system, the chart should get back to that level at some point. Might not be now, might be tomorrow, but it'll get there because you're trading 4 hour. You're swing trading, you're position trading. Now it gets to $700, $800 in profit. Take that stop loss, which is $1,000 in the red, because you've paid $1,000 for that trade now. Now you take that and you put it up to break even, or even $100 into profit, whatever the case, whatever makes you feel, floats your boat, makes you feel better. Now you're not paying for that trade anymore. Now that trade is completely free, and if it loses, you might even make a profit. Now don't think of it as if that comes back and now takes out the stop loss that you've lost all that profit, or that $700. You haven't lost anything, you haven't closed the trade. It's amazing how you think that when you're in the red, you can add to the trade and you're not losing anything, and when it comes back into a profit, you didn't make all that back in profit. That was in a loss. That was in what they call a drawdown. But there's no profit there. Yet if you go into profit and it comes back and takes out your stop loss, then you suddenly feel like you lost. Does not work like that. So when it goes into profit, let's say it goes 1,000, 200,000, 300 into profit. Now it's going into real profit. You push the stop loss up into profit, $500, $600, $700. You push it in behind it. Let's say your trade gets to target and you're $2,000 in profit. Don't click sell. Take your stop loss, move it up to $1,900, $100 behind the actual take profit. And if it moves north, you make more bonus. If it comes back and takes it out, you made as close to target as you want to, and it's good enough. You accept the profit and you walk away and you take the next trade. Now that's how our system works. Now what DCA says is they say that our risk system, the profits are too far away if you've got a 2-to-1 from the stop losses. So you've got to take your profits much quicker. You've got to scalp the markets and so on and so on and so on. Now that's not true if you look at the charts. If you take a step back and you look at the charts, your profit targets should be within those levels. Otherwise, your risk to reward is just no good. You want to take good risk to reward trades. So if you take the right trades, no, that's a fallacy. That's not true that your targets are too far away and you never reach them. That's not true. That's only if you take a really rubbish trade and you haven't worked out your risk to reward correctly, then that might happen. On a good trade where you can see that there's not much downside, but there's a lot of upside to your trade, then that risk to reward will play out, won't it? Then you'll make that profit. So you're looking for a good trade, number one. Now what the DCA guys will tell you is that all the pros don't have stop loss. And they're right. They don't, because you can't stop out with a trade that's got $88 million in it or something to that effect. It's a really difficult trade to stop out if there's hundreds and hundreds and hundreds of thousands of contracts or points or shares purchased. You can't stop them out in an instant. You have to find liquidity to stop them out and you have to find people that are prepared to buy them. So no stop loss for pros, which means they also don't day trade. They're also not trading on a fast measure either. They also buy slowly. They look for liquidity to buy. So they're not trading the same way that we are. The maths doesn't compute. Now, you are trading on a completely different system. You're trading with small amounts of money in comparison. You're trying to pick off their droppings, whatever they leave behind, you trying to pick up effectively. So you're looking for buys and sells in the market that are going to make you money. So now with our risk system, if you take 10 trades and in high probability you lose 5 and you win 5, but on the 5 that you win you make 10,000, on the 5 that you lose 5,000, you've made a $5,000 profit. That's as simple as it gets. On the DCA system, what they tell you is this: you take 1/10 of the trade. That's most of the guys will sell you. Take 1/10 of your size of your trade. So in other words, if you were going to risk $1,000, you're now going to risk it on $100. So you're going to take a $100 trade, not a $1,000 trade. So now you've got a $100 trade instead of a $1,000 trade. And let's say it moves straight up into profit and you make your money. Where the person on the risk management system would have made $2,000, you will now make the 10th of that, which is $200. Bully for you, you've made $200. Okay, you're already $1,800 behind. But let's say your DCA does do what it says it's supposed to do, and it goes down, goes into the red, and then I don't know how you guys actually work out exactly where you add, but I'm sure you have. Everybody has their own idea of that. So now you double up on the trade, you add to the trade, whatever the case, and you do that maybe 2 or 3 times. So you turn that $100 trade into a $400 trade. Okay, now you've got a decent sized trade. I'll give you the benefit of the doubt. We'll make it a $500 trade instead of a $1,000 trade or a $100 trade. Now you've got a $500 trade, but it's in the red, it's in arrears. When it gets to break even, I'm willing to bet you that most of you, when it gets to break even, will go, phew, I'm out of here, taking my money and I'm going. Because you've already added to that trade 3 or 4 times. But now it's like a relief. When you get to break even, it's like a relief. Most of you will duck out of that trade at $100 profit, or maybe best case scenario, $200 profit if it gets in. But most of you will get out at the actual break even just to get away from that trade, because it's given you so much stress. It's been in the red for such a long time and it's just been giving you pain. So eventually when it gets to break even, you just want to get out. Here's some more coffee. Do you get what I'm saying to you here? Doesn't make any sense to you. But let's say you're psychologically geared for this. Let's say you're good at this. Let's say you can get around this and you won't sell when it gets to break even, because now you've got a $500 trade that's going into the positive. Now to get that $500, just think of the maths here, guys. To get that $100 trade into a $500 trade, it's had to go quite deep. I mean, surely you didn't like just add to it in increments of like, very small moves. You obviously had to let it go quite deep for it to get to that $500. So by the time it gets to your break even, it's had to move quite far. So it's already had quite a vast move by the time it gets to break even. So you're busy thinking, well, if I hold this, it might turn around and go back down again. So you might sell a large portion of the trade. So some of you might actually sell a large portion of the trade. Let's say keep 100, keep 200, it goes up. And once again, you make $200. Or do the maths. You keep the whole trade, and by some amazing luck, it breaks up to the target and it gives you another $500 profit, where I would have made $2,000 profit. Just saying. Over the period of 10 trades, you possibly could make $2,000 to $3,000. Over the period of 10 trades, the risk system will make you $5,000. Just saying. Do you see the maths here? Do you see what I'm saying to you and what I'm getting at? That's if you become profitable with DCA. Because when you've been in the market for as long as I have, you have seen crashes. You have seen markets go into the toilet. And I've seen tears. I've seen people leave a trade in on a Friday, come back on a Monday, and they've lost their whole account. I've seen traders go into a market crash and come out the other side with nothing. Now, why is that? Simple. No risk management, no stop loss. Over the weekend, you don't have a stop loss because the market's closed. So it's very difficult to control that. So now a market crash happens and that thing starts falling and you're long. Whether it be Forex, commodity, index, doesn't matter. That thing starts going against you. It's going to keep on going against you. And the market can remain strong longer than you can remain liquid. It'll keep on going until it's taken all your money. And only when it's taken all your money will it turn around and go in your favor? But then you can't do anything about it, can you? Because it's taken too much. You see, the more percentage that the market takes off your account, the double amount of effort you have to put back to try and get it back. So if you lose 10% of your account, it takes a gargantuan amount of effort to actually put that money back, to put that 10% back. Believe me, it's not easy. So if you dollar cost average and you have a really bad trade and it goes against you and it doesn't work out, it'll probably eat up, if not all of your profits, all of your account. Because you'll keep on dollar cost averaging, you'll keep increasing the size of a losing trade. Now, I was equated to if you were a betting man, betting woman, and you were betting on a horse race, and your horse was winning, and it was 100 meters from the finishing line, and the bookie said to you, you can double your bet here. Most people I know would take that bet because it's a good bet, isn't it? You're 100 meters from the finishing line, you're winning. How can you possibly lose? So most people would take that bet. But if your horse is coming fifth and the winning horse is 100 meters from the finishing line, but you probably 200 meters from the finishing line, bookie says to you, you can double your bet. The logic behind this is your horse has got to get past 5 other horses, get a rocket up its whatever, and somehow win that race. So most people I know would say to the bookie, no, I don't think so. In fact, if I could get my money back here, I would, because I'm in the 5th place. Yet in the markets, in the stock market, we dollar cost average. We're coming 5th, but we add to our trade and we follow that losing trade as much as we possibly can. That's the logic behind it. So now, but if we're winning, we just get out. We click sell and we get out. We click sell and we get out. I mean, if you're scalping the market, you'll show me a win rate and you'll say, I've got this amazing win rate. I win on so many trades. But you're winning $10 on every trade. And then that one losing trade comes along and it takes 100 and it doesn't compute. You're making a loss. Win rates are meaningless. The market is 50-50. Hey guys, while you're here, if you want a free Forex book, drop down to the description and get it. It's free. I got it there for you. Enjoy it. Totally free. If you want the trade of the day every day, also join the membership and get the video every day, which gives a rundown on the markets and that sort of thing. That's also there to support the channel, let's say. A little bit of support for the channel. But guys, DCA is a bad trading system. It doesn't work. I have, over the years, tested it on numerous occasions. I've tried it in different ways. I've tried it where you'll just average down as they normally do. I've tried it where you sell out of the stock and try and buy back into the stock. That's a bit like revenge trading. That also doesn't work. So nothing really works when it comes to dollar cost averaging. It's insane, to be quite honest with you. And when the market turns against you, or when that share turns against you, or when that index turns against you, or Forex pair, that's when you feel the pain. The only place where dollar cost averaging actually works, and I wouldn't call it dollar cost averaging because it really isn't, but the way I invest in the markets and the way most people invest in the markets is where it works. Let's have some coffee. We'll talk about this now. Investing is a completely different ballgame. So my policy on investing is set and forget. So I will pick shares. I've picked shares years ago and I bought them. And now what I do is every month I add to them. I add to 1 or 2 of them, or 1 here or 1 there. Pick a share and I add to it. I never sell them. Never ever sell them. The only time I'll sell a share is if, for example, I see bad news about that particular company. I see that it's looking bad. Then I'll sell the entire pot, but I'll replace it with something else. Something good, better share, or whatever, add it into whatever pot is there. Now that is not really dollar cost averaging. What I'm doing is I'm buying more shares on a regular basis at any price. So whether it's higher, lower, doesn't matter. I wouldn't call it dollar cost averaging, but it does dollar cost average the price because you're adding to the stock. Now that's different because my investments don't have stop loss on them. I don't stop loss my investments. I trade like the pros do with investments. There, I'm just looking for liquidity. I'm looking to buy as much as I can. And I know that the bigger the pot becomes, the more difficult it is to sell it quickly in any event. And then when I'm old, those are the shares that are going to pay me back. Now, our 20%, 30% market crash or correction is not going to affect me in any way whatsoever because my share investments are on a one-to-one basis. They're not geared, they're not funded, or anything to that effect. So effectively, you've got a pot of money, it's in there, and it's going to go up and down, and it's always going to cycle its way up to the top over time, because I'm not looking for an immediate return. I'm not looking for it to return money to me in the next 15 minutes. I'm expecting it to return money to me in 20 years' time. And if you invest in the markets that way, over the period of 10 to 20 years, you'll be stunned and shocked at how much it can pay you back. Some people have become millionaires like that with crypto. I'm not a fan of crypto. People know that I don't like crypto. My opinion of crypto is it's fresh air, doesn't hold any asset value. So I would rather buy shares. So from my side, I buy shares, I buy companies. And from your side, you buy crypto, and you've done well. If you bought Bitcoin even at 5,000, it's 106,000 at the moment, or 100,000, 103,000 today. So look at it from that perspective. Look how many people became Bitcoin millionaires or crypto millionaires overnight, simply because they invested, they left it, and they came back, and it was worth a fortune. Same thing with shares, guys. You buy companies, does the same thing for you. So that's the only place where you could say, oh, I don't need a stop loss, and dollar cost averaging works. Because you're investing, it's a one-to-one. But that's a completely different approach to the market. It's a completely different idea to the market. It's not the same. Never will be, never has been. So if you want to know how our trading approach works, how we trade with price action, and how we approach the markets with our risk management system, which actually works, go to my last videos, go and check it out, and go and enjoy it. But guys, thanks for staying with me today and discussing this with me and watching this very straightforward, very basic video with not much going on in the way of charting or anything to that effect today. I just thought I needed to bring that up and I needed to discuss it with you. The maths of DCA does not compute. If anyone can show me how it computes, please do. Be my guest. But I can tell you now, it never has computed, it never will compute, it doesn't work. Thanks for watching, guys. Till the next one, cheers, thanks, and bye.